Number 2 is copper. Now, the doctor continues to sing a song that's quite inflationary, I might add, and Jeff Gundlach's done a good job explaining this. I believe in Barron's, he explained the relationship between gold and copper and saying, okay, look, when there's a lot more copper appreciation than there is gold, then that's an inflation signal to me. Now, I agree with that 100%, number 1. Number 2, it's happening again this morning. And number 3, it happened last week. So last week, gold was down 1.4% on the week. Copper was up 2.5% on the week. So again, a lot like kind of the Germany versus the FTSE situation, I'm looking at gold versus copper. So again, you're seeing divergences. In other words, these things are not telling you the same thing. Copper looks much different, check mark, versus gold, which does not look good. I should have just put a non-check mark. A non-check mark. That's not good. I know a lot of people are like, oh my God, look at my gold, it finally went up after it went straight down. Gold in the last 3 months, by the way, and this is the point. If you go back to where that gold chart really stopped going up, it's called Trump. So post the election, the economic data started to accelerate. You get rates up, dollar up, stocks up. That started the decline in gold. Then the dollar has like a 3-week correction. Gold gets a bounce, and now we're back down again. So again, interest rates up for 2 consecutive weeks. The 10-year bond yield's been up for back-to-back weeks as growth data continues to accelerate. We might get a lot of questions on that today because the GDP number wasn't as hot as we thought it would be on Friday, but it's still accelerated, and acceleration is still an acceleration. We were looking for well over the speed limit type of a number, and the reason why it wasn't was because net exports had a big drawdown, and that was something that was pretty difficult to model for. What isn't difficult to model for, by the way, on GDP is consumption. That number was just released this morning. Consumption and income numbers, again, right in line with where I guess Wall Street was expecting. I don't particularly care about what Wall Street expects on macro data. I care more about where are we in the trend. Are we accelerating, decelerating, et cetera? You currently have personal income up 3.5%, which is plenty, and 2.8% was the year-over-year consumption number. So again, that's why GDP consumption continues to look good, and GDP is higher than where the cycle low was, which is, of course, in Q2 of last year.